I'm Professor Scott Hegarty, and I'm going to talk through my good borrowing, bad borrowing presentation. I give it a lot of times at Northeastern, a lot of times through the Economic Inequality Initiative. Sometimes people miss it and they want to know what I talked about, so I've made a very brief walkthrough of what I talk about. In person, I talk a lot longer, and I take questions and go into more detail, but if you want to see sort of the basic ideas, you can watch my presentation. Primarily, I approach borrowing from an economic standpoint, which involves costs and benefits. Borrowing involves costs, such as primarily the interest rate, but also has benefits. If you borrow for something you need, then you benefit from it. So keeping costs and benefits in mind will help you make a good borrowing decision. Sometimes people think the right amount of borrowing is zero. They're anti-debt. That is not a good choice always, because borrowing gives you things that people really need, like an education or expanded business. Sometimes people need a car. Borrowing can get you those things. But if you're going to borrow, you shouldn't borrow too much. And so how much is too much? And so what to think about in terms of borrowing is knowing the true cost, understanding interest rates, as well as thinking about the benefits. And so some amount of borrowing might actually be good. So the big thing when to borrow is whether borrowing makes the difference between doing something and not doing it. So not going to college because you can't take out loans might hurt you both intellectually and in terms of lifetime earnings. But you always have to keep in mind how you can pay it back. So too much borrowing means that the debt payments become impossible to pay off. And sometimes that becomes a vicious circle of borrowing and not being able to pay it off and then borrowing some more. So in my mind, in my opinion, good borrowing could be things that are investment. So you're building your productivity, things like school and education, a car, which could actually help you be productive, a business, or sometimes a house, although I put a question mark there because houses are not always a good investment. But those are things that actually build productivity and can build income. But bad things are things that are used up right away, and so one thing I talk about is groceries, because you eat the groceries before the bill comes, and then sometimes you don't have enough money to pay for the next groceries and your bill, so you wind up taking out a loan or putting on your credit card to buy groceries again. And over time, if you can't keep up, you're paying interest on groceries that you ate months ago. All right, and so credit card companies sometimes do this. One big point I always make is that credit card companies are not bad. Some people are anti-business and anti-bank, and I don't subscribe to that. But you do have to keep in mind that banks do things to keep people borrowing, and they make money off of interest rates. They make money also off merchants paying a small percentage for every transaction, but they can also make money off of late fees. And so banks exist to make a profit like any business. But if you think about your borrowing, you can actually make a little bit of money by paying things off on time and not getting too far into debt. All right, so I always think of debt as a ratio. So some rules are to think of what debt is as a percentage of your income, and so too much debt, if it's not balanced by a large income, actually will become out of hand. And so if you think about debt that grows your income, it might actually be affordable because debt will increase, but income will increase too. All right, so think about the growth rate. If borrowing helps you grow faster, or helps you grow, then you might actually be better off borrowing. All right. One big mistake people make, and they're not helped by the financial industry, which also focuses on this, is people tend to focus on the monthly payment rather than the interest rate. So if you take out a car loan or a mortgage, the interest rate is there, but it might not be up front. You might have to ask about it, but people talk about how much can you afford per month. And sometimes people will actually wind up paying more money when really overall over the life of the loan, because they have a low monthly payment for more months. And so if your goal is to not pay extra interest more than you personally have to, then you might wish to think about the interest rate and take the lowest interest rate instead of the lowest monthly payment. But they'll tell you if you ask, but again, up front people will talk about what are you willing to pay per month, and I'll show you some numbers that show how it adds up. All right, so first of all, what is an interest rate? Interest rates are a lot of things. They're the payment to capital in economics. So anytime you take out a loan to buy machinery or a car or a new house, you're actually paying for what that car or house would give you. The equivalent is actually what the wage is to labor. So workers get paid and machinery gets paid interest. So that's sort of an economic view. Another view is psychological. People are patient, they're willing to save, and they're also willing to take low interest rates. But if people are unwilling to save or impatient, like they need the money now, they'll actually pay higher interest rates. The more you need the money today, the higher interest rate you will pay. All right. Economically, interest is also a payment over time. And so if you could basically transfer money between the present and future through the interest rate. I put money in the bank, and in the future I take my money out with interest. At the same time, I could borrow and take money from the future. In the future, I'll be paying myself back. I'll be getting the credit card bill and paying for something that I did now, but I'll be paying for it next month or next year. So interest has a lot of meanings, but really it's sort of the price of this access to cash. It's the price of access to money. Money can do things that are beneficial, but money also, the access to money isn't free. So we balance out these costs and benefits. And just like any economic transaction, it can be win-win. Right? Sometimes people think that money lenders or borrowing money can somehow be exploitative. Again, I don't believe that. It's like any business. Banks provide a service. They give us things that we need before we have the money for them, and they get something too because they get paid interest. So it's mutually beneficial like anything else. But for any product, if somebody overcharges, then it is kind of a ripoff. So there's a proper interest rate. Some businesses exceed that. So as long as everybody's fair, then interest rates are win-win. The borrower needs money and gets it. The lender has extra money and gets paid for transferring between people. All right, but just keep in mind that there is a right interest rate, and you have to look out to see if it's higher than it should be. All right, as I mentioned, interest rates shift money between the present and the future, and it's a balance of needs and usefulness, which is benefits and costs. Another thing we can do with math is we can show how long it takes for a loan or savings to grow. And so if you know compound interest, you know that if you put money in the bank, you earn interest this year, you have a little bit more, and that earns extra interest next year, and so forth. And so you actually can calculate interest on the interest, and eventually $100 could grow into $200. You can calculate how fast it doubles. Interest rates also vary by person and type of investment. People with different risk, different ages, different things that might make the bank less willing to lend because of the probability they might not get paid back. That leads to different interest rates for the same product. A young person might pay more for a car loan, for example. So younger people, college students, tend to be riskier because they have less of a history of credit, more likelihood that the bank won't get repaid. The bank balances out the likelihood they won't get any money back by charging people more when they do. Right, so to see how they double, to see how these interest rates double, we look at the rule of 72. And so if you take 72 divided by the interest rate, that's how many years it will take to double. So as interest rates go up, the doubling time goes down. So high interest rates are where money borrowed can easily get out of hand. So 3% interest rate, which could be typical, a little bit lower than a home loan, but fairly low. 72 divided by 3 is 24. So at that interest rate, the money that you have borrowed or saved will double in 24 years. At a really low interest rate, 144 years. So it doesn't grow that fast because interest rates are so low. And finally, a fairly high interest rate, 12%, your money would double in 6 years. And so if you're not making payments, if you're just letting that debt grow, you'll find out that you owe a lot more than you started with really quick. Credit card interest rates tend to be even higher than 12%, and so if you're not making any payments, you would be being racked with fees, but also you'll be paying interest that's compounding over time. All right, so what I did was I went online and I found something called an amortization calculator, and you can put in all the things that you would be, all the numbers that are relevant for any type of a loan. They're used for homes, but you can use them for cars, other items. You put in how much you're borrowing, how long the term is, and also the interest rate that you're offered. And you can actually see how much your payment will be and how much interest you'll pay in total over the life of the loan. And you can also see each payment. Usually you pay the same amount every month, but over time as you're paying down the debt, there's less interest to be paid, so the slice that goes to interest shrinks, and the slice that goes to the money you borrow or the principal actually grows. So even though it's one constant payment, the breakdown between interest and principal changes over time. Right. So what I put in was some numbers that work for a car loan. So I'm assuming that somebody's borrowing $15,000, which is the principal, and that's the cost of the car. And car loans tend to be about 4 years. Sometimes they're longer, and I'll explain that in a second. And also interest rate, I made up 5%, which is fairly decent for a car loan. Different people might have higher, and some people might have lower. But what you can do is you can actually calculate how much total you'll pay, which is going to be more than $15,000 because you're paying interest. And you're going to divide that over 48 months, and so each payment will be a constant fraction of that. And so you'll see how each payment breaks down. But what I want to also say is that if you ever do buy a car, they might offer you a choice of length of loan. Generally speaking, cars, especially used cars, don't last forever. And so they don't want you to owe money on a car that has broken down or ceased to exist. So because of that, car loans tend to be shorter than the life of the car, or how much life is left. But over time, cars have also gotten better. So cars might last 8 years, and so you could get an 8-year loan. And so you could be offered a number of different monthly payments. The longer loans tend to be lower per month because you're paying the same principal plus interest over more months. But you'll find out that it's cheaper in terms of a monthly payment, but it's also adds up to more total interest. So there's a trade-off, just like anything in economics. So the numbers I have here goes from 2016, and you can take out a 4-year loan from 2016 to 2020, and every month it's $345.44. And you can see the pie chart, interest and principal. Interest makes up a fairly large chunk, but every month you're paying down that original $15,000. And so over time, you're paying constantly $344, but over time there's less and less interest because you owe less and less money as you're paying it off. And so eventually you pay off the entire $15,000. But if you see here, the cost of that $15,000, which is the balanced out by the fact you get the car 4 years early, is $1,500. So you pay about an extra 10% over time to get the car early. Now, if the alternative is saving till you have all the money to buy a car cash, then that's worth it too to some people. But you get the car early. That's what you're paying $1,500 for. So it's a trade-off. But the monthly payment is fairly large. It's $345, but that's because it's over 4 years. What I did here is I did the long-term loan, which is possible for many used cars. And you see here the same amount of money. It's still a $15,000 car. But it's over 8 years, which means you're making 96 payments instead of 48. So it's more payments. And same interest rate. And so now you're paying off the car loan for 4 more years, and you won't have it paid off till 2024. And I cut out the 92 in the middle here. So here you'll see that as you go, the total interest is more than doubled. It's $3,000. So access to this car gives you a much lower monthly payment, but you are paying interest that's much higher over the life of the loan. And so it's kind of a trade-off, but I tell a lot of people to think about this as paying as little interest as possible, because you're only borrowing $15,000 either way. So you want to be able to have that money for other purposes. So shorter loans are a higher payment, which means more per month coming out, but total you wind up spending $18,000 if you have a long loan versus $16,500. So that's the trade-off, but paying interest is something that you can't use for something for yourself. It goes to the bank. All right, now I kind of changed some numbers. One thing I did was people try to buy as much car as they can afford sometimes. You can change these numbers to figure out what you can afford to hit a certain monthly payment. What I did here is a little bit different. I took this monthly payment and I changed the interest rate. So this is a really long-term loan, but I said, what if you have a high interest rate? You're high risk. You don't have work history. You're paying 23% interest. This is the same car. This is the same length as the last slide, but instead of $150, it's $300. That difference in the monthly payment is all because of high interest rates. So if you're facing high interest rates, you're actually paying much, much more in interest. And if you look down here, the total interest with this 23% interest rate is actually more than the car. Okay, it's not $1,500, it's $18,000. So that's the penalty of high interest rates. So anything you can do to increase your credit or avoid borrowing excessively at a high rate until you can get down to those lower numbers will actually mean more money for you and less money for the interest that you're paying. All right. That said, interest rates are not always known. A lot of times they're hidden. And so you might see that monthly payment. There's actually a way to calculate what that interest rate would be. And that's what I did. That 23% is whatever made those numbers line up. But for every payment and every length, there's an interest rate that matches, right? Because that's how fast it's growing. One place where it's hidden is payday loans, because it's not calculated by year. It's basically 1 or 2 weeks of borrowing in advance, and then there's an extra fee added on. That has to be converted to annual to be compared. And so the interest rates were extremely high, and they're regulated by a lot of states, including Illinois, at 400%, which is extremely high, obviously, but it's one where your money will double instantly, practically. So you have to make sure that the interest rates are known. Sometimes the state tells companies to do that, but payday loans have such high interest rate that debt grows so fast that people let it get out of hand or are unable to fix the situation. And debt spirals can be horrendous for people who are caught in them. So avoiding them in the first place is the best way to go, but making sure that you can make the payments is obviously good advice. And so this is the interest rate that I was talking about, an APR of over 400%. You're borrowing $50 and paying $41 for the principal, or for the 400, the original money that you're getting, but it's for the privilege of buying. All right, so think of 72 divided by 400. That's like months. Your money will double. All right. So to kind of sum up so far, before I give a couple examples, some borrowing is okay. You have to think of the use you can get out of it. If it's something worth doing, it can be worth borrowing for. Avoiding debt takes a cost. All right, but smart borrowers, if you really want to come out ahead, think of it as using your education. Think of using what you know as a way to kind of. I sometimes think of it as playing a game, but really the way you win is by paying as little interest as possible. But also you can get paid. One thing you can do, I talked about whether borrowing is worth it, right? Don't borrow money if it's something that gets either used up or doesn't give you anything, and so a lot of consumption might be avoided if you're paying interest, because instead of paying $80 for something, it could be $100. Think about the interest rates, that's the true cost, but also think about the penalties and rewards. There's a couple things. You can come out ahead with a credit card that gives points. And so borrowing money on a credit card, as long as you pay it off every month on time, will actually give you money. So I have an Amazon Visa, and I get money for Amazon. It's like almost handing me cash. So you get a little bit of money, and sometimes it's worth it. I buy gasoline at the gas station using credit. Just simply, cash is hard. You have to walk in, pay, fill up, and then get change or pay extra. So that's easier, and you also get points for it. So gasoline, even though I burn it instantly, is something that I use credit for. So rewards can sometimes be worth it, but there's also penalties. Sometimes people have like 6 months, same as cash, for purchases of furniture and things like that. You pay zero interest as long as you make the payments every month on time and have it paid off completely within that 6 months. But the way that companies come out ahead is that people get behind or just don't pay it off, and there's usually a penalty in that you pay the previous month's interest as back interest. So you feel like it's too good to be true that you get an interest-free loan. It's because you're sort of, maybe expected, or somehow, you might not pay it off, in which case you will pay them money. And if you balance out all customers, the ones who don't pay might be worth the ones who do. So as long as you're one of the few or one of the group that does pay, you do come out ahead. So think of it as ways where you can kind of come up with a little bit of extra money just for simply playing by the rules and paying things off. All right, and that leads to my other piece of advice, which is try to borrow from yourself. So I advise everybody to have some amount of money, a few $100s at least, to pay off things that you might have to turn to a credit card for. And you say, well, it's hard to save money. How am I going to come up with a few hundred? It might be hard, but what's worse is coming up with a few $100s to pay fees and interest in the credit card bill. So eventually you're going to owe somebody a few $100s, but it's going to be more if you're paying interest. So before anything happens, I would suggest saving up some money, so if a car repair or a speeding ticket or something comes, then you won't have to turn to payday loans or a credit card. And then even though it's hard to save, you might actually come out ahead by not getting into some sort of a debt cycle. Right? Sometimes people turn to payday loans for some event and then they are unable to make the payments. Same thing with credit cards, even though it's a lower interest rate. Avoiding the fact that, or a problem in which you can't make your payments, so you use all your cash, so you put the next thing on the credit card because you have no cash. So I really advise that. It's kind of going through the pain of saving early before you are forced to do it by a bank or a credit card company. All right, so here's just a couple examples. And again, when I talk in person, I spend much more detail on these, and depending on who's asking questions, people have different interests. And so here I just kind of talk about things that might be interesting to students or home buyers. Education, in my opinion, is a worthy investment, but a lot of colleges have a lot of extra costs, nice dormitories and activities and things like that. Borrowing for education helps you down the road, but borrowing because your dorm has a rock climbing wall might not be a good idea. So I suggest really thinking about the productive side of education. At Northeastern, it's pretty easy because pretty low tuition and a lot of student dollars go toward education. So any class you can take is worth it. I've known students at different schools who would only take classes when they had the money to pay for it, but classes aren't always offered when you have the money. They're offered every 2 years or every year. So being able to take classes you need when you need them might involve some loans, but education can pay off. Credit cards, I already mentioned. You can think of it as a short-term interest-free loan that has a catch. As long as you play by the rules and pay it off, you get those points. You get rewards. It also, in the modern world, actually helps you navigate a world where there's no cash. People sometimes only take credit. And one time I was at a restaurant, I tried paying cash, and they looked at me like I was from 1800. So credit cards are often necessary in many cases, and they're also necessary if you want to borrow in the future. College students in particular want to build their credit scores. All right, the cons, you have to pay back on time. The penalties kick in when you don't, so make sure that you're not getting too far ahead on borrowing. Sometimes you're told just to make the minimum payment, but the minimum payment avoids the penalties of paying too little, but they don't actually allow you to to chip away at the interest. So the minimum payment is an advised number, right? They advise that you pay it, but it is not enough to really pay off the principal in time to avoid interest. So pay as much as you can, and I do recommend all of it. All right. People sometimes lose track of budgets. You have to make sure that you're on time on your payments. If you confuse credit cards, or you pay your bills for $42 and you accidentally pay $41, you might actually wind up with a penalty. So make sure that you're on time, knowing all your due dates, and that you hit them, and you'll actually find out that you're getting more benefits than penalties. All right. Next example is home buying. All right. Now, sometimes I give seminars on home buying, and one of the points I always make is that the true cost of buying a home is not just the mortgage. All right. So there's pros, but people don't often look at the cons. All right. And again, homes are good in many cases, but just always know the true costs and benefits. So you can build equity. So instead of paying rent, you actually are paying down a mortgage and building wealth. Not everybody agrees whether it's an investment. You might be better off buying some kind of stocks or something like that with an advisor. A lot of people view home buying as part of the American dream, where home ownership gives you a stake in society. It makes you feel like you're part of your community. And people also, and economists call it forced savings, because it's hard to put money in the bank when you have other things to buy. But when you have a mortgage and you know you'll lose your home if you don't pay it, you put the money toward the mortgage. And part of every mortgage check, and not all of it, but part of it, goes toward paying down the money you borrowed. So every check you write gives a little more wealth. Right? And so it's like it disciplines you, because you have to make those payments. You have to build wealth. Right? And so those are the big ones. Now the cons is that people don't always take all the extra expenses in. And so sometimes people look at just the mortgage payment, but really there are some very important extra costs. Reduced flexibility. People can't move. You're in a neighborhood. You're in a city. Owning a home makes it harder to move from there, and you might have a good job opportunity, but a home might hold you back. There are transactions costs to buying and selling. You get the home inspected. You have it appraised. You have to pay a real estate agent. You have to pay a lawyer. You have to do a lot of different things to sell a house once you own it, and it's usually about 10% of the cost. Even from a buyer, you have to make sure that that it takes money to buy a house. Right? So when I say the returns are not that high, that's it's not a big wealth builder. It's not as comparable to many other investments. So buy a home to live in for the use it gives you, but not for the investment potential. Right? So I go back to this amortization calculator. A $250,000 house, I've got 5% down, which is kind of low, but typical for a lot of buyers. Mortgages tend to be 30 years, and I put in a 4% interest rate, which is a little bit lower than it is now. Put in some property taxes, insurance, and because you have a low down payment, you have to pay primary mortgage insurance because you don't have enough equity to be a low risk for the bank. So you have to actually insure your mortgage. And so plugging in those numbers gives you a mortgage payment of $1,100, But every bill, usually you pay property tax to your mortgage company instead of to the county. So you don't mail a separate check. You pay that as part of your mortgage. You'll pay insurance, which is just homeowners insurance, but you also pay this mortgage insurance. This adds up, and that's a typical mortgage payment. But a lot of times people will say, like, your mortgage is $1,100. That's the cost. That's lower than your rent. But the true cost, which is actually written on the bill, which you will pay, is $1,775, right? And so knowing the true cost is extremely important. So the mortgage is not the only part of the payment, and a lot of home buyers don't know that coming in. Taxes are large depending on where you live, and also insurance. And it breaks down. It is primarily, the biggest chunk is principal, but there's also a lot of your payment will go toward interest on the loan. And over time, you'll find out that you're paying $400,000 in these payments for a $250,000 house. All right, so the true cost will add up. And again, you're earning interest, or you're paying interest for 30 years. All right, so home buying it takes a lot of work to know the true costs and benefits, and it's a good decision for many people. But you always have to know how it benefits you personally. Car loans are also important for people. You need a car. It's hard to buy with cash because you have to save that cash. And so sometimes owning a car is a very good idea, but again, it depends on each person. The problem is people with bad credits might actually get really high interest rate. They used to have subprime home loans. Now they have subprime car loans for credit risks. So make sure that you're not overpaying. And I showed you how big those payments and interest can be. Right, and so you always have to make sure you're balancing the length of the loan. If you're given a choice, one thing that I would suggest, and I don't recommend it for everybody, is you could take the low payment and then just pay extra every month. But some people, that's kind of hard to do. It's sort of expecting people to really be disciplined. And if you can do it, then you get the flexibility. Pay extra like it's the short-term loan, but if something comes up, then you don't have to. But for the most part, the shorter length of time gets the car paid off and lowers the interest. All right. Normally at this time I take questions. Obviously I'm not doing that now, but the things to really think about from this presentation are balancing the costs and benefits of any kind of borrowing. Economics talks about the right amount of any decision, and so the right amount of loans might not be zero, and usually isn't. So if the benefits are worth it, then do it. And we know the cost, right? It can be the interest rate, knowing how the proper interest rate will allow us to borrow the right amount. And then also thinking about hidden interest rates, extra costs, and things that might actually change our decision once we have more information. So knowing the costs and knowing the benefits, we might actually be able to borrow the right amount and make our lives better. We have things we need, we're not overpaying on interest, and we're becoming savvy consumers. If you have any questions, you can contact me at Northeastern by email. Thank you.